Hello and welcome. I'm Ankur Mishra and you're watching a special edition of News Now. We are tracking a big macro number, IIP, for March 2025. As per government's new faster release schedule, the IIP print has come in at 3%, a notch higher than 2.9% in February. Manufacturing held steady with 3% growth. Electricity jumped sharply by 6.3%, but mining stayed pretty flat, growing just 0.4%. The recovery this time around has been led by sectors like basic metals, motor vehicles and electrical equipment. But is there a still bit of worry around the continued weakness in the consumer non-durables? To help us make sense of what these numbers mean for the economy, policy and markets, we have a power-packed panel joining us. Aditi Nayar, Chief Economist at ICRA, Swagata Bhattacharya, Member of Monetary Policy Committee, Jayesh Mehta, Vice Chairman DSP Finance. Welcome to all of you. My first question will be to Swagata. Do you think these numbers reflect a steadiness or you see this as fragile recovery?
Well, thank you, Ankur, for having me on your show. I think the numbers remain relatively soft, although these are close to expectations. So slightly lower than what I had expected, 3.4 to 3.5. So slightly lower than that. My own sense is this does show a fair bit of weakness. Mining, we already knew from the core sector numbers that we had seen earlier that mining would be relatively soft. The numbers that I've seen from the detailed sector-wise numbers, it's coming in largely from the sectors, the segments that you mentioned, particularly electronics and other equipment. My own guess is this partially reflects at least front loading of production and exports before the US tariffs would kick in. So my guess is we need to wait and see what happens after that. Once from the April numbers onwards, how these segments will react. But my own sense is this does reflect a sense of weakness, particularly in the manufacturing segment.
I want to come to you. Infra and capital goods are showing decent momentum. How much of this strength is actually sustainable as per your assessment? Aditi?
Yeah, thanks. The number that has come in today is a little bit lower than what we had penciled in. Our forecast was 3.3%, and I'm just wondering as to whether there has been any impact of the fact that the data is now coming out about 2 weeks ahead of the earlier schedule. We did notice in the release that the percentage of firms that have responded or the percentage of entities that have responded are a little lower than what was the case for the last few months. So there is a slightly higher possibility, I should say, that data could get revised for this month as compared to the kind of data revisions that we've seen in the past. Now, having said that, certainly at the use-based level, the data is very, very mixed. It continues to be extremely mixed as we've seen in the last few months. From the infrastructure capital goods side, one thing that we do suspect is that Government of India's own capex was also quite back-ended into Q4. That's the sense we have from some of the releases that we got from Government of India. But we need to wait till Wednesday to be sure, because that's when the data will be coming out. Actually, it will come out next month. Sorry, the March data will come out with a lag of another month. So we won't know quite for sure how to correlate that. And on the export side, it was very interesting when we got the trade data for the month of March. The overall numbers for exports are kind of flattish on March of last year. But when we look at the geography-wise split, then there is a huge diversion of goods to the US as compared to other geographies. Now, in the month of April, again, I think it will be quite interesting to see whether we end up seeing a bump up in the overall production, particularly on the manufacturing side, or again, is it a case of diversion to the US from other geographies?
Jayesh, how do you assess numbers from the point of view of liquidity, bond markets perspective?
The bond market, I think right now is in a different trajectory. Of course, it will be a little bit disappointed that it has come a little lower than the market expectation. But as you said, like, it is also because of the earlier number coming in. But more importantly, right now it's the other factors which are playing in. And so from a local perspective, it is on the trajectory of, pricing in next and maybe one more cut. And from that perspective, one market would be more or less indifferent to this number, though even though it comes a little bit lower than expectation. The only good part I would say on the whole thing is infra, which is kind of improved, and maybe the March number when it comes next month should have more better growth, and that should make the equity market a little bit happier. But bond market, I think, would be really not really too bothered about this minor change.
Saugata, I want to understand from you, how do you see these numbers from monetary policy stance point of view? Because there was some kind of assessment which was made when the monetary policy statement was made. But when you see these numbers now, do you think it reinforces that stance? I'm not asking for far forward guidance, but what was predicted in monetary policy and the numbers now?
No, absolutely. I mean, you remember that all the statements definitely emphasize the need to support growth. That monetary policy had the policy space to ease given the forecast of inflation. And I'm increasingly sanguine now that inflationary pressures are likely to remain relatively moderate in the near future at least. So this is nothing to give in terms of forward guidance, just in terms of the guidance in the last policy statement. So this opened up the space for the so-called good news rate cuts. That inflationary pressures were moderating, would remain durably aligned to the 4% target, and the number that we now see in terms of manufacturing. We had presumed that manufacturing growth, given the leading indicators that we had seen at that point in time, that the March numbers would remain relatively weak, which has been supported now by the IIP numbers. So I think the committee was right in emphasizing that there was a need to support growth at this point in time.
Jayesh, when you see these numbers from the point of view of next RBI move, of course there was a focus which was on growth, as Saugata was also mentioning. Do you think that in the next few policies we may expect the rate cut and these numbers will not have much of a hindrance?
Of course, in fact, the next policy, people are expecting a rate cut, that's for sure. Like I would say that's 98% probability, or 98% people are expecting a rate cut in the next policy. In June, I would say the expectation was like maybe 60-70% are expecting a rate cut, maybe the one after the June, the August one. Maybe 30-40% may not be expecting a rate cut, but softer number, of course, increases the rate cut probability by maybe 5% or so. But yeah, from a bond market perspective, as of right now, people are pricing in more rate cuts. There are some people who are actually pricing in 3-4 more rate cuts, which we'll have to see as we move forward. But at this juncture, I think there will be a good support from the RBI to support growth. As Saugata said, inflation looks very comfortable, and I don't think we need to right now focus too much on inflation. It will be basically focus on the growth, and that's why the bond market would be kind of always be constructive going forward for next 6 months, in this next couple of months.
Aditi, specifically talking about these numbers, I want to understand from you, in your perspective, which are the areas which has actually surprised you, both positive and negative?
Overall, the numbers are not very different from what we had penciled in, so I don't think it's much of a surprise really coming in as far as the data is concerned. I was able to look at the disaggregated data very quickly, and if I'm not mistaken, there is a sharp step down in the growth of capital goods. So I think that is something that we need to be watchful of, which is what I was talking about earlier. When we need to correlate it with the government data, etc. Now, going forward, our view is that with where inflation is expected to be in the next print, which is very, very benign, June rate cut is very much on the table. 98 to 100% probability, I think, of June rate cut. And August also, we see a very high chance of another back-to-back rate cut. But by then, we will have the GDP data for Q4 and for the full year as well. So maybe that will have some impact, but as of now, we think August is also quite likely to see a rate cut. Beyond that, I think we are at a pause right now, so we're looking at a total of 100 basis points in this cycle, out of which 50 is already happened.
All right. Swagata, if you talk about the GDP growth forecast, with these numbers, do you think the expectation of FY26 GDP may be better than what RBI has projected?
Again, I do not wish to speculate, but I think you're completely right that given the implicit number, I believe it was close to 7.6 for the fourth quarter. Given the early results that we have seen for the listed companies, the financial results of the listed companies, and now that we have the volume indicator coming in with the IIP, it might be entirely feasible that the predicted 6.4% might actually be undershot. So let's wait and see what happens. But these two indicators that we track, both on the financial results of the listed manufacturing and services companies, the early results that we have seen, and now the manufacturing indicators from the core and the IIP that we have now seen, would certainly raise the possibility of a further downward revision of FY25 GDP growth.
Aditi, what is your assessment of QY FY26 forecast? Does these numbers will have any of the bearing?
So Q4 FY25, you mean?
Yes, Q4 FY25 as well Q1 FY26.
So for Q4 FY25, we definitely expect the implicit NSO number to be undershot by a pretty big margin. We are looking at a full year GDP growth coming in around 6.3% for FY25. For FY26, we had started off with a growth projection of 6.5%, but given the uncertainty related to tariffs and trade, which we've seen over the last month, we actually think that there is going to be some loss to our earlier estimate, and we're now looking at a 6.2% GDP growth for FY26. I don't think it's the right time to really talk about quarterly forecasts. Even for the month of April, we don't have too many high frequencies right now, and we don't know a few fundamental things how the quarter is going to transpire. Firstly, are we going to see a large bump up in export-driven manufacturing, etc., in this quarter, or is it going to be business as usual? That's something we don't know. And other fundamental things also, what is the pace of government spending, both on the revenue side and the expenditure side. I think we need a little bit more of data to really be able to get a sense of how this quarter is moving. But for the year as a whole, we have reduced our growth forecast to 6.2% from 6.5%.
Jayesh, how do you assess the current situation whereby tariffs is something which everybody is debating? We also have geopolitical concerns which may or may not be happening. How do you think it may have impact on the growth prospects?
Of course, it's very uncertain, right? So we don't know how it's going to pan out on the tariff side. I think geopolitical is also concerned, but doesn't look like that will be a very escalated one. But we don't know as of right now. And but the tariff will have its own impact. It's not about just the US, right? The impact of others jumping in and the stuff like that. So we will have to see how that really pans out and where it gets concluded. Hopefully by end of this month we will see something coming up, maybe by early first week of May or so. But as of right now, of course, all this uncertainty it's just not the tariff with the US, right? So it's also about the globe slowdown, which can impact overall slowdown. So that's what the worry is.
Right, Swagata. Right, Swagata, I want to understand from you, when we saw your MPC minutes, almost all the members, including you, were saying that inflation is something which is under control. Growth is something where, including Governor mentioned that focus should remain now. Which are the steps you think, monetary wise, we know that what RBI is doing. Which are the fiscal steps you think government should take?
Well, it'll be difficult for me to say this. Obviously, I mean, you've seen in the budget that the government is also trying to support growth. I mean, the cut in personal income taxes was a very major step that the government took. And obviously, I mean, it's going to play out over the next 4 or 5 months as the tax filings go out, etc. The savings on taxes that we might see at some point in time. So, but that will take some time. I think in the meantime, there is a case now that too much moderation in the fiscal deficit, say for instance, or in revenue expenditure, that needs to be balanced against considerations of fiscal austerity, fiscal moderation, etc. And the government has proved very adept at balancing, calibrating its fiscal response. So at this point in time, of course, I mean, as Jayesh also mentioned, and the first line in my minutes, that forecasts don't really make much sense at this point in time, given this extreme uncertainty that we have at this point in time. It's just the direction of travel that is getting indicated with this. But I do support, and I completely agree with you, that it has to be a mix of policies. Depending on the contingent on the actual the happenings in tariffs and trade, etc. That oil prices are likely to remain low. Industrial commodities prices are likely to remain low. We need to see how potential Chinese and other Southeast Asian dumping and into India might play out on growth and prices. So all of these, the mix coming in from all these potential and other developments is likely to shape the growth and inflation balance. And it has to be coordinated policy response with monetary, fiscal, trade, industry, commerce, etc. A whole bunch of things needs to be pulled in together. But the essential, the object of this, given contingent on our expectations of moderate inflation, is the need to support growth at this point in time.
Aditi, for the benefit of viewers, I want you to explain particularly the change of date of IIP release. You mentioned that 28 days lag. What is it and how will it actually benefit?
Okay, before that, I just want to add 2 more points. I mean, what can really be done to support growth at this point in time? I think we can definitely gain a lot from a front loading of expenditure, particularly capital expenditure at the state and the central government level. So we're hoping for that. I am afraid that in this situation of uncertainty, private capex is only going to get deferred further. So I think that is something that, that's one of the reasons why we reduced our growth forecast for the full year. Now, in terms of the timing issue, earlier the IIP used to be released with a gap of about 6 weeks. It used to come on the 12th of every month, unless it was a holiday. And just to, talk about the extent of the lag, on the same day we used to get the CPI for the previous month and the IIP for 2 months back. So basically, CPI data we used to get with a 2-week lag from the month ending, and IIP we used to get with about a 6-week lag from the month ending. So that used to come on the 12th of every month. Now instead of 12th of the month, it will come on 28th of the previous month, which means that the lag has been brought down to 4 weeks from 6 weeks. Now, at times in the past, what we've seen with the IIP is that sometimes there have been issues where not an adequate amount of reporting may have happened, and therefore the initial data could have been very different from the revised data. So now we just need to see going forward, when we get data with a 4-week lag instead of a 6-week lag, are we getting an appropriate number of responses, a high enough number of responses with the 4-week lag data, so that the revision in the data which happens subsequently is not to a very large degree. Typically, IIP we get 3 releases. We get the first release, 6-week lag, which is now being brought down to 4 weeks. Then we get a revision in the next month, and 2 months after that. So first, second and fourth month, that is the way that the IIP release schedule is and the updation schedule is there.
Thank you for explaining that. Swagata, since we are talking about growth, we are talking about economy, I also have minutes of meeting where you mentioned about I did have prior reservations on changing the policy stance to accommodative. I have associated a neutral stance with the flexibility for policy to respond appropriately to the changing and balancing of risk. I just wanted to understand that why this change happened in this policy since we are talking to you.
So first, before I get into that, so one more thing that I need to Aditi's explanation, very comprehensive explanation of the change, is that one of the factors that has enabled this change, the shortening of the release period for the IIP, is that more and more of these surveys are now, because these are surveys, remember, so these are now computer-assisted, so-called CAPI surveys, computer-assisted interface surveys. So that has enabled, that is one of the enablers for shortening the time frame for releasing the data. So that's one. We need to see, as Aditi mentioned, how is there a bigger revision that is necessitated by the advancing the release date. On the stance, it was very clear that the balance of probability, very dominant balance of probability, was that there would not typically be a need to raise rates at this point in time. Remember that only a very few stressed country central banks have been raising rates. All the others are either paused or cutting. So except for Japan, which is an extraordinary case. So the balance of probability for the need to raise rates at this point in time was considered to be relatively low, and that was the shift to accommodate. My prior reservation was the sense that, you need to have that optionality or flexibility to be able to pause if the situation so demanded. So, if our projections on inflation, growth, etc. remain as we have seen in the past two MPC meetings, then there is also potentially not any real reason to pause inter-policy meeting. As Aditi and Jayesh mentioned, there might be, we don't know yet what the neutral natural rates are, so that's coming in later. But it might be an important part of the flexibility of policy to be able to pause during if something adverse happens or some uncertainty creeps into this statement. So that was essentially the shift in stance. And there is also, the stance is essentially a guidance mechanism, a guidance tool. So the direction of travel for monetary policy is towards lower rates at this point.
Thank you so much, Swagata, Aditi and Jayesh for joining at this hour and breaking down these IIP numbers. But for